Welcome to Lesson 5, The Cost of Trading, Understanding the Spread in Forex. Today we're going to demystify the concept of spread, a term you've likely encountered in your trading journey but perhaps haven't fully grasped its significance. Imagine a bustling marketplace, where merchants are selling goods and buyers are looking for the best deals. The spread, in essence, is the gap between what the merchants want for their goods and what the buyers are willing to pay. In the world of Forex, this marketplace is virtual, and the goods are currency pairs. The spread is the difference between the buying price and the selling price of a currency pair. This subtle difference might not seem like much, but it's crucial to understanding the costs involved in Forex trading. You see, every time you trade a currency pair, you're essentially stepping into this marketplace. You're buying at one price, hoping to sell at another, and the spread is where these two prices meet. But why is it important to understand the spread? Well, it plays a significant role in your trading strategy and overall profitability. It's the cost you pay every time you enter a trade, and it's how brokers make their money. In a sense, it's the toll you pay to cross the bridge from one currency to another. So, how can we measure this spread? It's quantified in pips, which represent minor price movements in currency values. We'll delve deeper into this in the coming segments. We'll also explore the differences between fixed and variable spreads. Fixed spreads remain constant, while variable spreads fluctuate with market conditions. Each has its advantages and disadvantages, and choosing between them can greatly influence your trading strategy and profitability. By the end of this lesson, you'll have a solid understanding of what the spread is, how it's measured, and how it impacts your trading. You'll also learn how to make informed choices about which type of spread suits your trading style best. Now that you understand what a spread is, let's dive deeper into its components. In every Forex transaction, there are two prices involved, the bid and the ask price. These two prices, in essence, set the stage for the play that is Forex trading. Let's start with the bid price. Picture yourself at an auction, you're the seller, and you've got a precious artifact to sell. The bid price is what buyers are willing to pay for your artifact. In the Forex market, the bid price is the highest price a Forex trader is willing to pay for a currency pair. Now, let's move on to the ask price. Going back to our auction, imagine you're now the buyer. The ask price is the lowest price at which the seller is willing to part with their precious artifact. In Forex terms, the ask price is the minimum price that a Forex trader is willing to accept for a currency pair. But why should you care about these prices? Well, they're instrumental in determining the spread. In the simplest terms, the spread is the difference between the bid and the ask price. It's essentially the price you pay to play the game that is Forex trading. So, if the bid price for a currency pair is $1 and the ask price is $1.10, the spread would be 10 cents. This 10 cents represents the cost of the transaction. Keep in mind, though, that these prices aren't static. They're in a constant dance, swaying to the rhythm of the market's supply and demand. As such, the bid and ask prices, and by extension the spread, can fluctuate throughout the trading day. In conclusion, understanding the bid and ask prices is fundamental to grasping the concept of spread. They're the yin and yang of Forex trading, two halves of the whole that is each transaction. The bid and ask prices are integral to the spread, but the broker plays a pivotal role as well. So, let's delve into the broker's role in our next scene. Stay tuned. Forex brokers play a significant role in the spread. The spread, as we've already established, is the difference between the bid and ask prices of a currency pair. This difference is not merely a random number, but it's a key factor in how Forex brokers earn their keep. You see, traditionally, brokers made their money through a straightforward commission on each trade. You make a trade, and a portion of that goes to your broker. Simple, right? But with Forex, it's a bit different. Instead of a flat commission, brokers typically generate revenue through the spread. Think of it like this. When you go to a currency exchange booth to exchange your dollars for euros, there's a difference between the price at which they're buying dollars and the price at which they're selling euros. That difference, that's where the currency exchange booth makes its money, and that's pretty much how Forex brokers operate too. Let's break it down a bit further. When a broker offers a currency pair for trading, they'll quote two prices, the bid price and the ask price. The bid price is the highest price that the broker is willing to pay to buy the currency pair. On the other hand, the ask price is the lowest price at which the broker is willing to sell the currency pair. The spread, then, is the difference between these two prices. In essence, The broker buys at one price and sells at another, and the spread is their profit margin. This method of earning allows brokers to present a commission-free trading environment, which can be quite attractive to traders. But remember, it's not actually free. The cost is simply built into the spread. As you navigate the world of Forex trading, it's crucial to keep this in mind. Different brokers may offer different spreads, and these can significantly impact your trading costs. So always take a close look at the spread before you jump into a trade. While the broker's role is essential, it's also important to understand the spread as a transaction cost. Every Forex trade you make comes with an inherent cost, the spread. Picture it as the toll gate you must pass through every time you enter or exit a trade. This toll, or spread, is the gap between the buying and selling price of a currency pair. Now let's imagine you're a trader. You see a tantalizing opportunity and decide to jump on it. You buy a currency pair, but the moment you enter the trade, you're in a slight deficit. That's the spread at work. It's the price you pay to play the game, the transaction cost that impacts your overall trading profitability. The spread isn't a hidden fee or an additional charge tacked on by your broker. It's an integral part of the Forex market structure, a cost you'll encounter whether you're trading dollars for euros, yen for pounds, or any other currency pair. Now that we know about the cost, how do we measure the spread? That's what we'll uncover in the next scene. Spreads in Forex trading are measured in pips. Now, what's a pip, you may ask? Well, it's an acronym for percentage and point, and it represents the smallest movement a currency pair can make. So if the EUR/USD moves from 1.4000 to 1.4001, that's a 1 pip increase. When we talk about the spread, we're talking about the difference between the bid and the ask price, measured in pips. For example, if the bid price is 1.4000 and the ask price is 1.4002, the spread is 2 pips. This difference in pips is crucial to understand because it directly impacts your trading profitability. Each pip that the price moves in your favor is a pip of profit. Conversely, each pip that it moves against you is a pip of loss. Understanding how to measure the spread leads us to the next topic: fixed versus variable spreads. There are two types of spreads in Forex trading: fixed and variable. Now let's delve into what each of these terms mean and how they play out in different trading scenarios. Fixed spreads, as the name suggests, remain constant. Regardless of market volatility or liquidity conditions, the spread you see is the spread you get. This can be a good option for traders who prefer predictability, offering a sense of control and stability. Imagine being in the middle of a storm, but knowing exactly how wide the path is. That's kind of what trading with fixed spreads feels like. On the flip side, we have variable spreads. These are dynamic in nature, fluctuating in response to market conditions. During times of high liquidity, these spreads can be quite narrow, potentially providing a cost advantage. However, during periods of low liquidity or high volatility, such as when a major economic announcement is made, these spreads can widen significantly. Picture navigating through a calm sea that can suddenly turn choppy. That's the nature of variable spreads. The key difference between the two lies in their response to market conditions. Fixed spreads are immune to market volatility, offering a consistent trading cost. Variable spreads, on the other hand, are a reflection of market conditions, providing opportunities for cost savings during high liquidity, but posing potential cost risks during volatile periods. So, which is better? Well, it really depends on your trading style and risk tolerance. If you're a cautious trader, you might prefer the certainty of fixed spreads. But if you're adventurous and willing to ride the waves of market volatility, variable spreads might be more up your alley. In essence, neither spread type is inherently superior. Each has its own unique features and suitability for different trading scenarios. As a trader, your task is to understand these nuances and choose the spread type that best aligns with your trading strategy and risk appetite. Remember, each type of spread has its own advantages and disadvantages. Choosing between fixed and variable spreads depends on understanding their pros and cons. Let's dive into the advantages and disadvantages of both, shall we? First off, fixed spreads. Their primary advantage is predictability. Regardless of market volatility, traders know exactly what spread they'll be working with. This can be particularly beneficial during peak trading hours when market fluctuations can be wild and unpredictable. It provides a sense of security, knowing that your transaction costs won't spike suddenly. However, fixed spreads aren't without their drawbacks. They tend to be wider than variable spreads under normal market conditions, which means you could be paying more in transaction costs. Also, during times of low volatility, when the market is quiet, these wider spreads can eat into your potential profits. Now let's turn our attention to variable spreads. Their main advantage is that they can be narrower than fixed spreads during normal market conditions. This means lower transaction costs, which can enhance your trading profitability. Plus, they reflect real market conditions, providing a more authentic trading experience. But as with everything in life, variable spreads come with their own set of challenges. They're susceptible to market volatility. During economic announcements or unforeseen events, spreads can widen dramatically, leading to higher costs. This unpredictability can add an extra layer of risk to your trading. So, in a nutshell, fixed spreads offer predictability at the potential cost of higher transaction fees, while variable spreads offer the possibility of lower costs, but with the added risk of market volatility. Each type of spread has its own unique set of advantages and disadvantages. It's up to individual traders to weigh these up against their trading style, risk tolerance, and strategy. Now that you have a clearer understanding of fixed and variable spreads, how do you choose between them? That's what we'll explore in the next scene. The choice between fixed and variable spreads depends on several factors. As we delve deeper into this fascinating world of Forex, we come to a critical junction, deciding between fixed and variable spreads. Fixed spreads, as you may recall, are constant. They remain the same regardless of market conditions. This predictability can be a boon for traders who value stability and certainty. If you're the kind of trader who likes to know exactly what your costs will be, fixed spreads might be your cup of tea. On the flip side, we have variable spreads. These are dynamic and fluctuate with market conditions. They can be as volatile as a stormy sea or as tranquil as a calm lake, all depending on the ebb and flow of the market. If you're an adventurous trader, one who thrives on the thrill of unpredictability and the potential for lower costs when the market is calm, variable spreads could be your choice of weapon. But it's not just about your trading style. Market volatility plays a significant role too. In highly volatile markets, variable spreads can widen, increasing your costs. Fixed spreads, however, remain unchanged, offering a layer of protection against such fluctuations. Yet, in quieter markets, variable spreads can narrow, potentially reducing your costs compared to fixed spreads. Hence, your choice could also depend on the times at which you trade. Do you trade during peak market hours when volatility is high, or do you prefer quieter times? Lastly, personal preferences matter a lot. Some traders may prefer the certainty of fixed spreads, while others may be drawn to the potential cost savings of variable spreads during quieter market periods. So in conclusion, choosing between fixed and variable spreads is a balancing act. It's about understanding your trading style, gauging market volatility, and aligning these with your personal preferences. Congratulations, you've completed Lesson 5, Understanding the Spread in Forex. We encourage you to start the next lesson, Forex Trading Terminology. Thank you for joining us on this educational journey into the world of Forex.